Many people approach their credit reports with the assumption that the goal is simply to remove negative accounts or improve a number, but the credit strategy framework begins with a very different perspective because it focuses on understanding the structure of the credit profile before deciding what action, if any, should be taken. The idea behind the credit strategy framework is simple but powerful. Instead of reacting emotionally to the presence of negative information, the framework encourages individuals to step back and analyze the report as a structured financial record that tells a story about how credit has been used over time. This approach recognizes that a credit report is not just a list of accounts, but a timeline of financial behavior that lenders examine when evaluating risk. The credit strategy framework is built around three core stages, which are analyze, interpret, and decide. The first stage is analysis. Analysis involves carefully reviewing the entire credit report to understand what information exists and how that information fits together within the larger credit profile. During the analysis stage, the goal is not to react, but to observe. Each account is examined for accuracy, payment history is reviewed to identify patterns, balances are compared to credit limits to understand utilization, and the age of accounts is considered to evaluate how long credit relationships have existed. This process allows someone to see the complete structure of the credit profile rather than focusing on one isolated account that may appear negative at first glance. The second stage of the framework is interpretation. Once the report has been analyzed, it becomes possible to interpret what the information might mean from the perspective of a lender reviewing the same data. Lenders typically evaluate credit reports by looking for patterns that suggest stability or risk. A history of on-time payments across multiple accounts may signal reliability. Balanced credit utilization may indicate responsible financial management. Longer account histories may suggest experience with credit. On the other hand, sudden increases in balances, several recent late payments, or a cluster of newly opened accounts may signal financial pressure. Interpretation allows consumers to view their reports the way lenders might view them, which helps transform the report from a confusing document into a readable financial narrative. The third stage of the framework is decision. Only after the report has been analyzed and interpreted does the framework encourage deciding whether any action is necessary. In some cases, inaccurate information may need to be addressed through the dispute process. In other cases, the report may simply reflect past financial events that cannot be changed, but may gradually lose influence as the credit profile continues to evolve. The key principle is that action should be deliberate rather than impulsive. When someone reacts immediately to negative information, they may focus on the wrong problem or take steps that do not improve the overall profile. By following the sequence of analyze, interpret, and decide, individuals gain a clearer understanding of how their financial history appears within the credit system. Another important aspect of the credit strategy framework is that it encourages long-term thinking rather than short-term reactions. Credit profiles evolve slowly over time as accounts age, balances change, and payment history grows. Each month that passes adds another entry to the financial timeline recorded in the credit report. Understanding this gradual evolution helps people recognize that credit improvement is often the result of consistent financial behavior rather than sudden actions. The framework, therefore, shifts attention away from quick fixes and toward understanding the structure of the credit profile itself. Once someone understands how lenders interpret the report, they begin to recognize which elements of the profile matter most. Payment history becomes easier to understand because it represents reliability across time. Credit utilization becomes meaningful because it reveals how responsibly available credit is used. Account age becomes important because it reflects experience with credit relationships. These signals combine to form the patterns lenders evaluate when reviewing applications. The credit strategy framework encourages people to study these patterns instead of reacting to individual items that appear negative. When someone learns to analyze their credit profile using this approach, the report becomes less intimidating because it begins to resemble a financial history rather than a confusing list of accounts. Each account contributes a piece of the overall story. By understanding how those pieces interact, individuals gain the ability to interpret their credit reports with greater clarity. Instead of reacting to numbers or isolated events, they begin to understand the larger financial narrative being recorded. That shift in perspective is what the credit strategy framework is designed to achieve. It transforms the way people think about their credit reports by encouraging thoughtful analysis before action, helping them make decisions based on understanding rather than frustration.